Why are the stock markets rising at a time when the economy is struggling? I'm pretty sure you would have asked yourself this question at some point in the last couple of months, and it probably makes sense. After all, the country is yet to come out of a financially crippling global pandemic, industrial production is stagnant, many essential sectors are still struggling to reach pre-COVID levels, government debt levels are high, there is high unemployment, and in spite of all this, the stock market continues to go higher. Hi everyone, my name is Shankar Nath, and in this video, we put forward some reasons and hypotheses as to why the stock markets continue to defy the current state of the economy. It's a topic where most people will have their own opinions, but as investors, it's always a good idea to look at a problem from multiple angles, and that will be our endeavor here. The primary premise for this astonishing rise in the stock markets is that the economy is coming back to pre-COVID levels. To understand this better, let's look at some publicly available data. On the industrial front, the IIP, or the Index of Industrial Production, is a key measure of industrial activity. On an year-on-year basis, the IIP is just kind of coming up to the pre-COVID levels, although it's still not there. In terms of positives, the GST collections have been making good strides since September, which is a promising sign. There have been improvements in railway and roadway freight movement, improvement in power consumption, the demand for steel has jumped. Another positive has been the double-digit growth in tractor and two-wheeler sales on an year-on-year basis. Unfortunately, there have been a lot of negatives as well, and in many essential areas. Like our country's merchandise and services trade, which includes both exports and imports, are roughly 11% lower when compared to the same time last year. Consumer transportation via air, railways, and the sale of four-wheelers continues to be low due to the movement restrictions. More importantly, the unemployment rate is still high at 9.1% as of December 2020. To put this into perspective, the unemployment rate in mid-2017 was barely 3.4%, so there's a lot that needs to be done there. Net, all the data we have seems to be pointing out that things did not turn out to be as bad as was once expected, but there is still some lost ground that needs to be regained. With that being said, it's possible that there are more factors at play, so let's see what else might be working here. The second premise that is lifting the stock markets is the optimism surrounding potentially superlative earnings. And why would there be higher earnings? There are many reasons that have been forwarded, and in isolation, each of it makes perfect sense. One, the lowering of the corporate tax rate, which was done in September 2019, will get a complete and a normal year of action in FY22. So that's something to look forward to. Two, the pandemic has rushed all companies to refocus on their cost structures, and the expected cost savings is likely to add to the profits. The third reason is the government stimulus through the budget announcements and also much before the budget, which spans across the spectrum. The beneficiaries of this include MSMEs who can avail collateral-free loans and equity infusion. Then there are production-linked incentive schemes for 10 key sectors to boost India's manufacturing capabilities and exports, infrastructure and housing incentives, pipeline projects, healthcare spending, and a lot more. Now, the perspective here is that while all these initiatives sound promising, what we really need to understand is the extent to which corporate profitability needs to grow to justify the high stock market levels. So let's start with a little background here. The Nifty EPS, or earnings per share, has been a struggler for the last 5 years now, with the EPS growth always remaining in single digits. Before COVID struck in March 2020, the Nifty EPS was at 440 and the Nifty was then at 11,000 points. Assuming the stock markets were fairly priced in March 2020, a back-of-the-envelope calculation shows that the Nifty earnings would have been around 590 by FY22 for it to support the current price of 14,700. This figure of 590 becomes all the more significant when we compare it with the current EPS of 370, which means the lower taxes, cost savings, government spending, and all other stimulus put together needs to grow the Nifty EPS by 60% from the current level of 370 in a span of 1 to 2 years, which can be quite a challenge. This being said, as investors, it is important to see how the EPS grows over the next 2 quarters to judge the extent of the growth in corporate earnings. Why does a central bank reduce interest rates? Simply said, this action is taken to stimulate economic growth, and that happens by lowering the financing cost, which encourages corporates to borrow and invest and encourages individuals to borrow and spend. The expected effects of this corporate and consumer spending are growth in economic activity, higher employment, and greater demand for goods and services. In our opinion, a lot of this economic growth will be linked to improvement in consumer sentiment, which will need the coming together of other factors like vaccination drives, opening up of travel, restarting entertainment avenues, all of which have started to happen from this quarter. Secondly, a low interest rate regime often acts as a catalyst for the movement of money from fixed income products like fixed deposits to riskier assets like equities. The reason for this reallocation of wealth is the lower yield that bonds will now offer. This hunt for higher yields is universal, which also ends up attracting foreign institutional investors or FIIs to invest in the Indian stock markets. To put it in numbers, in the last 2 months of 2020, that's November and December, FIIs poured in 1.13 lakh crores of money, which has been one of the major reasons for the recent jump in the Indian stock markets. But one needs to be watchful here. After all, money introduced by these foreign institutional investors is often called hot money, as it tends to move from one place to the other, often from one country to the other, depending on where the opportunities are. So as quickly as they bring in the money, it doesn't take them much time to move it away. Another significant impact of a low interest rate scenario that investors should be wary of is that lower borrowing costs often fuel asset prices, which increases inflation. Now this is bound to happen as more money chases fewer assets, which jacks up the price. We are already seeing price spurts in commodities, real estate, Bitcoin, metal, and of course in equity. Now, as inflation and asset prices increase, the RBI, which is always monitoring the situation, is likely to normalize interest rates, and a number of the gains mentioned here might go away. But for now, the combination of low interest rates, foreign money, and liquidity seems to have a bearing on the stock market rise. Now, this is an interesting one. What we have here is a unique valuation perspective of why the stock markets are rising. It starts with a valuation tool called the discounted cash flow, or the DCF method. Very simply, the DCF method estimates the value of an investment based on its expected future cash flows. This is done by estimating cash flows over a number of years and then dividing it by a discount rate to arrive at the present value of these cash flows. The two key assumptions here are one, the growth rate, and second, the discount rate. Now, we have discussed a bit on growth in the first section of this video, so we won't go back to that. In fact, for this analysis, let's assume growth at 0% just to better explain this point. Okay, now we come to the star of the show, the discount rate. The discount rate is a quantification of the risk of any investment and is calculated by summing up the risk-free rate and the equity risk premium. We won't get into the specifics of risk-free rate and equity risk premium in this video, but if you want to geek out, then watch the YouTube video by Ashwath Damodaran for greater insights. Let's stick to the math now. Let's say the equity analysts in asset management companies, Wall Street, Dalal Street, have been using 12% as the discount rate for calculating the intrinsic value of equity investments. This means for year 1, the present value will be calculated as 100 divided by 1 plus 12%, which comes to 89.3. The same concept when applied to year 2 will yield a present value of 79.7 and so on for 10 years. Once we add all these up, we get the sum of present values, which comes to 565 rupees. Now what does this mean? It means today I am ready to pay a maximum of 565 rupees for the opportunity to earn 100 rupees every year for the next 10 years. And this is how a simple discounted cash flow model works. Now let's pan our attention to current times. With interest rates and bond yields falling, an equity analyst might say, hey, let me reduce the discount rate to compensate for the drop in interest rates. And then he or she goes ahead and assumes a discount of say 9% instead of 12%. And this is where things become interesting. At 9%, our year 1 present value will now be higher than 89.3. In fact, it will come to 91.7. Similarly, year 2, year 3 and all other years will show a higher present value. So when we sum up the present values at 9% discounting, we end up with 641 rupees. In other words, the analyst is now telling you, the investor, that you can now pay up to 641 rupees for the opportunity to earn 100 rupees per year for the next 10 years. Are you getting it? Notice what happened here. The cash flow remained the same, the growth remained the same. The only change we did was we changed the assumption called the discount rate. But due to the small change, our equity analyst, who was earlier saying 565 rupees, is now comfortable paying up to 641 rupees. That's an upside of almost 14%, which kind of shows how a small change in assumptions can have a profound effect on the pricing of assets like equities. And who knows, maybe this is in some part responsible for why the stock markets are rising so much. The stock markets have had a fantastic run-up in these last 10 months. And one won't be wrong to assume that many investors are spooked by it. The data available also seems to indicate that the Indian economy is still a wee bit away from reaching pre-COVID levels and is probably a year or two from stabilizing. The big question is, what should one do about this rising stock market? One suggestion we can propose is to solution your strategy on the basis of your time horizon. So if you need money in the short term, one can look at redeeming some equity investments and booking profits. If you are a medium-term investor, then use this opportunity to de-risk your portfolio by rebalancing. This would automatically reduce your exposure in equities. In fact, medium-term investors can re-look at their asset allocation too and start adding gold and international equities in their portfolio in addition to domestic equities and debt. And finally, if you are a long-term investor who's building wealth for many years for now, you should continue to play the disciplined investing game by continuing with your SIPs in equity mutual funds. And with this, we come to the end of this video. I hope you liked our content and will draw many learnings from the data and insight presented. Don't forget to subscribe, like, comment and share this video with your friends and colleagues. Thank you for watching and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.